Morning, everyone. Welcome to the Macro Snapshot. Let me just put up the volume. We are Friday, December the 12th, 2025, recording this in the morning. Okay, so let's have a immediate look at a few different markets, see what's going on. There's not much data today. What we do have is some Fed speakers. So we have Schmidt and Goolsbee, and both of them were dissenters on the hawkish side, voting for no cut at all. So they'll be speaking today to talk about their decision, which could be interesting just to get a sense of what the Hawks are thinking. We also have Miran, who of course was a dovish dissenter with 50 basis points cut. So we do have these two extremes speaking today, as well as a couple of other Fed speakers. And keeping in mind that there are a lot of so-called silent dissenters with the dot plot from last Wednesday, it is going to be interesting to see just sort of under the hood a little bit what's happening at the FOMC and no data. Okay, so I just want to start off and look at some of the precious metals. We see that silver continues to rip much higher. Now, of course, on all sort of metrics, this is sort of technically overbought and we're going to sort of all-time highs at this point. But, you know, whichever way you want to look at it, I just want to put on some EMAs and whatnot. This is just a very strong downtrend, and there's zero technical damage done at this point. There's zero sort of bearishness here. So there's zero reason to be short this, even though it does look overextended on the RSIs and whatnot. And if we look at that, we can look at a couple of RSIs. Just put on the some of the stochastics here. So if we look, we can see that the RSI, is up to 77, 78, which, was this at levels where it pulled back before? Yes, so we had a RSI of 80 going back in October, this kind of level here you see on the chart. And did it pull back? Yes, it did. So, can this pull back? Absolutely, it can pull back. But something which I just want to put into context is that if you look at, let's say, the classical EMAs, which is the 20, 50, 100, and 200, still in a very strong uptrend. But also if you look on a sort of a shorter term, so this is like the 8, 16, 32, and 64, you can see it still hasn't violated any of the moving averages. And just for a bit of perspective, I just want to put like a sort of a longer term, it's like what a CTA kind of sort of trend following systematic fund would be having. This is much longer term sort of EMAs. And you can see that from their perspective, this is an uptrend, which essentially began, sort of 9 or 12 months ago down here, and they've had no reason really to actually even exit the positions. Probably with the higher volatility, they've come down here a little bit, but that's just like a volatility reduction of size. So at this point, the volatility is going up. There could be some reductions of size, but until and unless this really pulls back dramatically, things like the systematic sort of trend followers, the CTAs, will still be in this trade. So all that to say, in terms of silver, if you're in the trade, congratulations, and just hold it. And what you might consider doing is some kind of collar where you have a sold call, you sell a call and maybe put a long protective put around your core position. So a protective collar is sort of interesting. Now in terms of where this could go, you see that I've got a measured Fibonacci extension here. Are we getting overextended? Yes. But one could argue that having breached this sort of level of 1, which is a key Fibonacci extension, one could argue that the 1.618 is the next sort of logical level from a sort of algorithmic or sort of numbers-based perspective, which would be up at 71.5, which is still, as you can see, quite a lot more to go. So silver going strong. And also gold is breaking out. So if we look here at gold, you can see that it had been in a sideways sort of a bullish consolidation pattern here. It's now broken out. It looks as though the next stop is the new highs at 44.34 on the futures. Or if you look at spot here, you can see that that's about, what have we got? Yeah, 43.85. So still a little bit more to go. Now, could gold sort of bump its head along the top here and sort of take a little bit of a pause? Absolutely. And maybe that would be the signal there for silver to take a pause. So let's keep an eye on the gold chart here. But again, there's some reasons for that. And, if you look back at what Powell said, a lot, we've had 48 hours to digest the Fed. And essentially, Powell said that his legacy, he was asked what is the legacy he wishes to use. And he says, I want to leave an economy which is strong. He also said, and I mentioned this yesterday, he said that, the long-term yields are not going up because of inflation concerns. They're going up because of sort of economic expansion and growth. And he also said that, in terms of the affordability crisis, that the best way to get out of that, because inflation is actually not going up, there's high prices, is actually to run the economy. He didn't say run it hot, but essentially said to have wage growth and a strong economy and a strong labor market. So my personal view here is that the Fed, and plus we do have a little bit of sort of bills purchasing, sort of 20, 30 billion extra net per month. And at the end of the day, this is more liquidity into the banking system, whichever way you want to look at it. And so putting all these factors together, I think we are going to have a sort of a strong economy next year. And keep in mind that a lot of the Trump initiatives, such as deregulation and sort of tax cuts and all these kind of things, they're still around and still could actually sort of come more online. So and the point I'm sort of giving this sort of macro overview is to say that in that kind of situation, you have a situation where you have a government running it hot, you have a Fed which is, prepared not to be too restrictive, and you have potentially a little bit of debasement of the dollar and, a sticky inflation environment. And that's going to be good for the precious metals. You also start looking here. You start looking at some of the you see the break evens on the inflation rate. They're not. They've gone up a little bit, but they're just. It seems as though they're kind of stuck at this level here. Sort of in the longer term. Now that's different from the affordability and the high level of prices, but in terms of inflation itself, it seems to be at about 2.5-ish%. And the Fed is basically seems to be saying that hey, they're okay with that. And by the way, in their summary of economic projections, they also said that they do believe that over the medium term, the next 2 or 3 years, that will be coming down slowly. Okay, so if that's the situation, we have stronger growth, and that's going to cause real yields to go up. So an approximation here of the real yields, you have the 10-year nominal subtract the break evens, and you can see here that real yields on the 10-year, for example, are pushing higher. Okay, so Powell's basically saying, well, this is healthy because this is sort of normal in an expanding and buoyant economy. Okay, so in that situation, you've got to say, well, maybe the dollar is going to sort of be a bit weakened if we think that the Treasury is issuing too many bonds, and this is a bit of a haven here for the precious metals. So the point I'm trying to make here is that let's keep an eye on the price action. The price action is still positive. There's no reason to be shorting any of these precious metals, and at this point, the idea is that when you reach highs, you wait for a breakout. When you reach highs, maybe either take a bit of profit or wait for a dip or put a protective collar. Now, what is also interesting is copper, keeping an eye on the copper price here. And it's interesting in the US here, you see that copper is not exploding as much as the precious metals, and that could also be because in China there's some talk about some of their large sort of developers. I think it's Vanke. The government has essentially sort of suggested that they're not in any mood to bail it out, and they want to let it find its own equilibrium. So we do have a bit of sort of the developer, the real estate segment in China being depressed. And keep in mind that China is still, the greatest global consumer of copper. Nonetheless, the high grade contract trading in New York is at a pretty key level here. It's the 61.8 fib retracement. Let's see what happens here. It looks as though it's finding a bit of resistance, but if gold and silver continue to push higher, you'd have to think that maybe copper is sort of an industrial cousin may want to go higher. It's also interesting to compare that to the London price. Now, this is the London. This is priced in per, sort of a different sort of pricing metric here, but you can see that that's also quite strong. And I just want to show you some of the dynamics going on with the copper market. This is the inventory levels of the three major global sort of exchanges. So you've got the London Metal Exchange in this sort of a very dark blue here. You've got the Shanghai Exchange, obviously important for China. And then in the pale blue here, you've got COMEX. So this is the totality of stocks. And what's interesting is that if you look at this, one would be tempted to say, well, hold on, this is a bit strange because we have inventory levels in the futures warehouses at highs which we haven't seen since going back to COVID. So surely that should be sort of bearish for copper. But what's interesting, if you look at COMEX, which is the New York exchange in the pale blue, you can see that its relative share, look at this, its relative share has gone up massively over the last sort of period. And basically what that's causing is a lot of sort of almost like an artificial sort of sucking of most sort of a lot of the world's copper supplies into the US inventories, into the US sort of warehouses. And why is that? That's because there's a sense that Trump could label copper as some kind of sort of restricted metal, and there could be extra tariffs. And so a lot of traders are sort of stockpiling and hoarding in a certain sense, and that's taking away supplies from the other two exchanges and in the rest of the world. Let's say China and London, the other big trading centers, which is artificially pushing up the price. So when I say artificial, it's a real reason for it. But we'll see if real demand over the next sort of 3, 4, 5, 6 months is a part of that. And I've just got a little bit of a commentary here on that. So you can see it rose to a 7-year high at 660 kilotons here. Uh, so 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 the point is here is that 61% of the total is now held in the US warehouses, and that's the HG contract, HG high grade. Okay. Now, if you look at this time last year, those stocks stood at just 15%. Sorry, at the 7% of global exchange monitored inventories. So we used to have, at COMEX 7% of inventories globally. It's now 61%. So this is clearly a little bit of financial speculation here. Which is basically, as they say in the tweet here, which is effectively stranding a large share of global copper in the US. Okay, and that's tightening availability elsewhere and underpinning prices. So that's the logic there. So just getting back to the copper chart, again, this is why I think copper is an interesting one because you can see here the price is going up. This is the London price, and as I say, if we go back to the high grade traded in New York, you can see that's also been going up. Now, whether that's purely a result of this kind of financial speculation and hoarding at the COMEX inventory warehouses in New York, or whether this is a sign of demand. Certainly, the global macro backdrop is supportive for copper, electrification, AI, data centers, electric vehicles, etc., etc. But just in the short term, be interesting to see. So the point is here, monitor those warehouses, the stock levels there, the stockpile levels in New York. If they were to go lower, that would indicate, copper sort of flowing out to the other exchanges, and you'd expect to see copper selling off here. Just while we're on the metals, you can also see that it's got the platinum ETF up here. You can also see that that's starting to push out here. It's been a bit slow, but that's definitely pushing out here. Platinum and also palladium, which hasn't got a lot of have a lot. That's an interesting one. This is PALL, which is the ETF. Looks like a bit of a bull flag here. It's broken out here, and if silver and gold continue to rocket higher, you'd have to think that palladium, a bit of a laggard here, may want to sort of test a little bit higher as well. That could be an interesting one. Just while we're talking about all this stuff, let's just keep a look at and see what's going on with the bonds. So what we've got here, you see here the 2s 30s curve steepening, and we've really seen since the Fed meeting on Wednesday. You can see here just what's going on here. So if you look at the 1-year yields, you can see that they've gone down a little bit. Looking at the 2-year, they initially sold off. The yields dropped, on that sort of relatively dovish cut. And then you look here at the 5-year, you can already see that like the 5-year didn't go down as much and it's starting to push higher. And then if you look at the 10, you can also see how the yield is pushing higher and the 30-year yield pushing a lot higher. So what's basically happening here is that we are getting a steepening of the curve. So the front end of the yield, let's say the 1 and 2-year, is relatively anchored, saying, hey, the Fed cut. Powell's telling us that, he said, oh, I don't think it's not his base case to hike anymore. So any sort of pressure on the yields, that's going to be expressed through the belly and the longer end of the yield. And the economy, as I say, is starting to run a little bit hot. So that's why you're starting to see even something like the 2s to the 5s. Look at this yield curve here. This is very steepening. So you've got this is a bear steepening here. You've got the 5-year yield really going up a lot more than the 2-year yield. And you say, well, why is that? And that's because the 2-year yield is essentially anchored because the Fed, in some shape or form is probably cutting another once or twice over the next, 3, 6, 9 months or so. Whereas the real economy is starting to heat up. Inflation is still a little bit sticky. And that's being reflected a little bit further out on the curve. In this case, the 5-year, which is pushing higher. And you can see here, let's say the 2s, 10s also steepening, but not as greatly as the 2s, 5s. And again, something I showed you a while ago, just to look at the butterfly, you can see the relative sort of performance here of the different yield curves. So in this case, we have the 2s, we've got the 5s, the 2s, and the 30s. So this is basically saying, if you go long, so to speak, the yield, you can see that that's outperforming the 2s and the 30-year yield. So the 2s and the 30-year yields on those wings are sort of staying lower comparative to the 5-year. And if we look at the butterfly, using the sorry, that's the wrong one. Here we want the so the 2s, so the 5s, 2s, and 10s. You can see here that the 5s are really the yields are completely going up a lot more than the wings on the 2s and the 10s. So what is that telling us? It's telling us that the economy is doing quite well. Um, and on the other hand, there are some concerns about inflation, maybe debasement of the currency. Talking about currency, it's not a huge amount for the dollar this morning, relatively flat. You can see that here, it has been selling off, but just having a bit of a comeback. So just taking a little bit of a pause. Oil continues to trade on the heavy side, despite, Trump is talking about doing sort of ground operations over there, the seizing of Venezuelan tankers and whatnot. But oil does seem to be trading heavily. And at a certain point, you've got to say, is this a positive for the economy, having a sort of cheaper oil? Probably, definitely sort of deflationary to have cheaper energy. I'm going to keep an eye on this price level. If it does sort of drift down towards the 56 or so, there could be an interesting short-term reactive bounce sort of opportunity if it goes down another couple of bucks down there. We saw that Nat Gas also had a crazy, they don't call it the Widowmaker for nothing. You see here, Nat Gas, the contracts, the last 4 or 5 days has come down about 20% or so. I mean, a part of that is like this triple top here, overhead resistance. You see a very key level, and look at that to the tick, it bounced. But also, basically weather reports coming in, had some colder weather over or sort of eastern North America. That's dissipating some of those weather reports. The 6 to 10 day, 10 to 15 day weather reports are calling for slightly or less frigid weathers, less cold weather, and that's of course the front end of the curve here, NG1, to actually sell off pretty dramatically. Although the sort of later contracts, February and March, are still a little bit higher. So all in all, energy prices, at good levels. That's deflationary. The Fed will like that. Trump will like that. In terms of some other things here, just want to have a quick look at the equities to finish off. You can see here, obviously Oracle sold off on, disappointment to the market yesterday. It came back a little bit, but Oracle down, basically about 10% or so. But you still see the S&P 500 here clinging, pretty close to the top. NASDAQ a little weaker, based on some, Oracle and some of the other mag companies. But what I would point out is just the Russell absolutely ripping here, ripping to highs. As you can see, sort of relative highs, maybe even all-time highs at this point. And what's interesting, if you look at the channel, the Russell does have some room to go. So you could say that the Russell, for the technicians out there, you could argue it still has about 4 to 5% to go. Again, if you look at a lot of those moving averages here, you can see the Russell, really the shorter term one, really sort of turning over. So the 20 has crossed over the 50 comfortably, and now all of those longer term ones are looking to turn up. So the Russell are doing very well. And what we're seeing here is a little bit of rotation, because you see that the Mag 7 on the ETF mags, it's not that it's doing horribly, but it's sort of underperforming something like the RSP, which is the equal weight, which is, very similar to the Russell price action. And you can see here that small caps and equal weight really outperforming the mega cap sort of Mag 7, so to speak. So that's the interesting one there. That looks as though it's in sort of blue sky, so to speak, and could push a lot higher. And that's being reflected in the breadth of the market. You can see here, as you see here, the percentage of S&P 500 stocks above their 50-day moving average, and you can see here that that's turning up quite nicely, and we've gone from being pretty sort of a lack of breadth, 35 to 40% now, almost up to 60%. So basically, it seems to be a bit of rotation happening, and overall, one would have to say that that's possibly going to be a positive for the stock market going into Christmas. We still have a couple of weeks for Christmas, so still possibility of a Santa rally, and looking at that, that looks like another sort of bull flag breaking out in terms of the breadth. So it looks as though the Russell may be able to power on. We shall see today. Okay, guys, so that's it. I'm going to wrap it up here on Friday morning. As I say, let's keep an eye out for Goolsby and Schmidt. Their case, the bear case, or the hawkish case, they'll be outlining that today. So have a great trading day and a great weekend. We'll be back here on Monday with the macro snapshot. Thank you.